Good morning. My name is Charles Taerk, and I'm one of the portfolio managers that run the 9-Point Alternative Health Fund. 2019 was the first full year for the Canadian licensed producers to offer adult use recreational cannabis in Canada. The year also offered significant expansion of state-by-state operations from U.S. multi-state operators we refer to as MSOs. Despite the excitement and anticipation of what was expected to be a transformational year, 2019 was a challenging period for the Canadian cannabis sector as regulatory delays and supply chain issues hampered sales. As a result, many public companies witnessed equity value drops of over 70%. The promise of significant quarter-over-quarter revenue growth in Canada did not materialize for many of the LPs, and the ability to generate positive cash flow, or EBITDA, has become a focus of investor concern. Key impediments facing Canadian producers include what to do about previous overbuilding of cultivation capacity, a lack of coordination among provinces under the Federal Cannabis Act, and most importantly, a lack of storefronts in Canada's most populous province, Ontario. South of the border, leading U.S. MSOs showed an ability either through organic growth or through the acquisition of select companies to achieve positive metrics, such as double-digit same-store sales growth, quarter-over-quarter revenue growth, as well as quarter-over-quarter growth in positive cash flows. We believe that the operational trends we saw in 2019 in the U.S. will be similar to the trends that we are going to see in 2020. And as a result, we continue to favor the U.S. market. It has a larger addressable market. There's 200 million people in 33 states that have some form of legalization versus 37 million people across Canada. There's also an ability to brand and market a broad array of products. MSOs can directly own storefronts as well as distribute through wholesale their products to other independent stores, allowing for wider distribution of brands. And with the 2018 passing of the Farm Bill, hemp-derived CBD in topical formats continues to be distributed throughout all 50 states. Now you can see in the chart the financial differences we've seen in 2019 between the Canadian and U.S. operators in the cannabis space. Despite the strength of U.S. MSOs, though, the U.S.-focused names still trade at a discount to their Canadian counterparts. Our active management, coupled with our ability to invest in a more diversified portfolio, assisted in generating significant outperformance relative to all other cannabis-related funds and ETFs. The fund had slightly negative performance of negative 5.7% for the year, while the marijuana ETF, HMMJ, was down close to 34% for 2019. From inception, we designed the fund to provide flexibility, especially during difficult markets. We believed from the beginning, when we launched the fund in March of 2017, that there was not enough liquidity in the Canadian cannabis sector to manage a 100% cannabis-focused fund. The last 2 years of investing and the resulting volatility illustrates the need for active management, due diligence, and diversification, especially when investing in an early-stage sector. We believe that 2020 offers a great opportunity to invest in select cannabis-focused names. We see many catalysts that can serve to expand the U.S. landscape for legal adult usage, while the U.S. will offer more opportunities to access capital for growing MSOs. As these catalysts hit, we believe we will see positive equity response from the leading MSOs. In addition, the long-term investment opportunity in the Canadian cannabis sector still exists, but patience is needed. One way to gain an economic interest in certain Canadian LPs while managing risk is emphasized in our option writing program. This past year, Our option writing program generated a solid $1.8 million in option premium, despite reduced exposure to the high volatility Canadian cannabis names. We believe that the best way to manage the volatility and risk associated with an investment in this early stage sector is to be in an actively managed fund that provides diversification, risk mitigation, liquidity, and the ability to adjust our sector allocations. So let's look at the year ahead for the Canadian market. Companies operating in the Canadian cannabis industry have raised billions of dollars in capital, with the majority of funds directed at building out production capacity, retail operations, and preparing for Cannabis 2.0. However, the rollout of recreational cannabis in Canada has been challenging. Lack of retail storefronts has hurt the national rollout, and the one-year delay in the rollout of consumer products has resulted in a strengthened black market. These issues have conspired against many Canadian producers, such that many miss their own financial projections. Many continue to burn through cash while attempting to scale up operations. The result is that many Canadian companies are not able to generate sufficient cash flow in the near term, and many may never turn the corner to positive cash flow. Given the lackluster equity performance of many of these companies, investors are unwilling to support the build-out of these new operations. We continue to believe in the long-term growth of the cannabis industry. It's still in its initial stages, and there will be winners who can take advantage of the opportunities offered to them. Unfortunately, we see the likelihood that there will also be losers in the sector, meaning public companies running out of cash and the Canadian industry likely facing bankruptcies in 2020. Despite this challenging backdrop, opportunities still exist in the Canadian market. We believe that this kind of environment favors low-cost producers with established distribution agreements with the different provinces. Without additional capital flowing into the sector, low-cost producers are in a position to take market share from less efficient producers. We also favor those companies that are focused on extraction services, offering solutions to cannabis producers and consumer packaged goods companies that want to add cannabis and hemp products to their lineup of existing well-known brands. So in the first year since legalization, Statistics Canada reported that Canadians spent approximately $900 million on non-medical legal cannabis. Despite the low number of physical storefronts, Ontario accounted for the most sales of any province at close to $220 million, followed by Alberta at close to $200 million and Quebec at close to $190 million. What's interesting is that with a population of over 14 million people in Ontario, Ontario is more than 3 times the population size of Alberta at 4.4 million, yet we're only generating 10% more in cannabis sales. The reason falls squarely on store count. Alberta has been the most efficient province at implementing legal cannabis storefront licenses, while Ontario has been one of the most disappointing. Alberta holds the top rank among provinces with the most storefronts open or licensed, with a total of 384. Ontario has 24 storefronts, with an additional 75 licenses to date. It's worth noting that sales have shown to ramp with physical storefronts. A StatsCan report notes that as the number of stores increased in 2019, the proportion of online sales declined from 40% in October 2018 to under 10% in September 2019. More stores leads to more education, more understanding, and less stigma. With the recent announcements from Ontario to begin issuing dispensaries or storefront licenses under a more open system beginning in April, we anticipate close to 150 stores should be operating in Ontario by the end of 2020. That will help all Canadian producers. However, much of that growth will not take place until the second half of the year. So people ask us, what's the right number? How many dispensaries should we have in Ontario? A way to analyze effective dispensary coverage is to estimate the number of dispensaries based on the number of points of sale with respect to alcohol distribution in the country. There are approximately 5,500 people per liquor store or per liquor point of sale in Canada, and that implies 6,800 liquor points of sale. With a current dispensary count of just over 750, we estimate that without a build-out of storefronts, domestic consumption patterns will be constrained relative to the growth seen in the US. What's also important to consider is that with the most populous provinces, they're well below the number of dispensaries that can effectively service their markets. As Canada launches recreational products, or the Rec 2.0 products, we believe that derivative products, extracts, beverages, edibles will unlock significant growth and value in the Canadian market. However, investors need to be realistic on an appropriate time frame upon which to see the financial effects of the rollout. Despite a number of producers announcing plans to launch a range of products, we do not expect to see meaningful sales of derivative products until the summer of 2020. This all goes back to storefront count. As we saw last year, the producers will need to work with provincial supply managers while attempting to manufacture derivatives at scale for the first time. In addition, consumers will also need to be educated about these new products. So, do we have a couple of companies that we want to highlight from the Canadian cannabis market in 2020? Two companies that may be poised for success in 2020 are Village Farms International and MediPharm Labs. VFF, for Village Farms, through its Pure Sun Farms JV, is a low-cost producer of cannabis that has achieved significant market penetration and is poised to improve on this in 2020 with additional capacity and supply agreements with various provinces. VFF is leveraging more than 30 years of fresh produce cultivation experience with millions of square feet of greenhouse space to propel its operation. Currently, the JV produces 75,000 kilograms per year and has become the low-cost greenhouse grower in Canada, with all-in production costs in its most recent quarter of 48 cents per gram. In its first month of sales to the Ontario Cannabis Store and Ontario-based dispensaries, the Pure Sun Farms JV had the top-selling rec brand on both a volume and dollar basis in October. In addition, VFF's JV partner is struggling to raise sufficient cash to fund its portion of the joint venture, which may allow Village Farms to obtain higher levels of ownership in the joint venture. Now, with constrained capital environments taking place in Canada and the launch of Cannabis 2.0 products, we believe that MediPharm, or Labs, is poised for significant growth in 2020. We believe the company is well positioned to provide distillate and isolate as the market for edibles, topicals, beverages, and vapes expands both in Canada and abroad. Financial results from Labs has been strong with Q3 revenues of $43.4 million, a gross margin of 34%, adjusted EBITDA of $10 million, and net income of $5.4 million. The company has 8 long-term white label contracts to work with producers and consumer products companies entering the Cannabis 2.0 market. With greater demand for extraction, tighter capital markets hampering additional competitors from entering the market, and successful international expansion in its Australian operations, all of these factors should drive positive results for MediPharm in the coming year. So what about the US market and expectations for the multi-state operators? Large US MSOs and their acquisitions are closing, and they will be a catalyst for the sector. as these long-awaited transactions will remove uncertainty from a regulatory perspective, as well as reduce risks in financial models related to pro forma results. 6 transactions have received HSR approval, which serves as sufficient evidence that the U.S. Justice Department process is not the major roadblock to growth for MSOs as was perceived almost a year ago. We believe that the SAFE Act is passed by the Senate in 2020, and this will act as a significant catalyst as barriers to capital will be reduced and growth capital will be accessed from a number of different sources. Of course, FDIC institutions will become free from reprisal of dealing with what has been deemed to be a federally illegal business. This removes a major hurdle for these businesses to deal with. Next is the more open landscape that MSOs will have when dealing with landlords, REITs, and with insurance companies, all currently significant challenges to daily business operations. We do not believe that the SAFE Act's delay relates to less political will behind the bill. It is, however, subject to political opportunism, with each side, Republicans and Democrats, seeking to maximize perceived political benefits for their side. Republicans generally favor a narrower, more defined bill, while the Democrats seek to include social justice provisions. As a result, while there is bipartisan support for the intent of the bill, the details are still being actively debated. We see the SAFE Act as a bill that gets full political coverage in this election year. The Republicans who control the Senate intend to use its passage to strengthen certain Senate races for their party members. Another catalyst in the upcoming year south of the border is the number of additional states that currently are medical only interested to become recreational adult usage cannabis states. Early 2020 predictions are for continued growth in the U.S. market, with states such as Michigan and Illinois already having gone rec. Michigan began December 1st and Illinois January 1st. And on January 1st, Illinois, being very organized, had all of the stores from its incumbents ready to open and ready to go. Other states where there is significant support to add recreational adult usage include Arizona, New York, New Jersey, Pennsylvania, Connecticut, Rhode Island, and potentially Florida. Ballot initiatives for recreational legislation are expected in states like Arizona, Montana, Missouri, Oklahoma, and South Dakota. New York and New Jersey could vote for recreational use as long as agreements can be met on taxation, regulation, and social equity referendums that need to be addressed. In the Northeast, the governors of New York and New Jersey are in discussions with the governors of Connecticut and Rhode Island, given their unique proximity to each other, for a common blueprint of rules and regulations for adult recreational use. And in Virginia, with the state government controlled by the Democrats, that is, the governor, the House, and the Senate, it appears more likely that Virginia sees adult recreational usage becoming legal in the near term. But it's not just going from medical to rec that is changing the map in the United States. There are currently 33 states legal for medical use, and that number could rise in 2020. Medical marijuana programs are being discussed in states such as Idaho, Iowa, Missouri, Nebraska, North Dakota, Arkansas, Mississippi, Utah, and Wyoming. Regulations need to be worked out in each state, such as allowable conditions to be treated, licensing of medical practitioners, dispensary permits, tax collection, as well as how to determine acceptable treatments. And they continue to affect the growth of these programs, as do restrictions on certain formats for cannabis medication. The key point in this discussion, and by reviewing the comparison of current legal states versus predicted legal states, the population of the U.S. that could be within cannabis legalization may approach 250 million people, bringing more opportunity, more patients, and more clients for dispensaries across the U.S. As 2019 ends and 2020 begins, tighter capital markets are favoring established players. The leading multi-state operators, the incumbent names, have an advantage in tight capital markets, and we're seeing that as new debt and equity facilities are being announced. Curaleaf recently announced a debt financing of US $300 million in financing from a syndicate of traditional US lenders to assist in refinancing existing debt while also providing capital for the company's growth. We have also seen US-based REITs become involved in supporting the leading names in the US, with recent announcements of sale leasebacks involving Trulieve Cannabis and Cura. The amounts being made available and the more reasonable terms of the transactions are providing a reduced cost of capital for those more seasoned players, further driving a wedge between the haves and the have-nots. We continue to see value in those leading MSOs that continue to build their operational footprints profitably. So, are there companies to watch in the U.S. cannabis space? As stated previously, we believe that the well-capitalized U.S. MSOs will be solid performers in 2020. With its commanding market share in Florida and enviable balance sheet, Trulieve, symbol TRUL, T-R-U-L, is set to continue to post industry-leading profitability levels while it cautiously expands to additional states. Trulieve has 44 dispensaries in the state of Florida. Florida is the third largest state in the U.S., and its medical cannabis patient count is now almost 300,000, up 81% year over year. Trulieve continues to dominate sales volumes and dollar value in this market with a 51% share of smokable dried flower and 47% share of all cannabis products sold. So we believe strongly in the growth of Trulieve. Another U.S. MSO we believe in is Green Thumb Industries. Its home state is Illinois. It's the sixth largest state in the U.S. by population with 12.7 million people. And it's the second largest state to have legalized adult use after California. GTI's 40 stores in 12 different states give it the second largest dispensary footprint amongst MSOs in the U.S., positioning the company to continue on its plans to distribute brands at scale across multiple states. Financially, GTI also has strong operating cash flow with strong same-store sales growth, double-digit quarter-over-quarter revenue growth, and a growing wholesale distribution that allows GTI to build its brand in approximately 700 different dispensaries across the 12 states in which it operates. So what's our portfolio strategy for 2020? We continue to favor US MSOs and look to select those companies that stand out in terms of growth in revenues and cash flows. We will also focus on those leading brands that are making inroads as new consumers continue to become more comfortable with new product formats, better dosage, and effective delivery methods. And we'll continue to select those Canadian producers that are gaining market share while lowering costs of operations. In terms of the non-cannabis portion of the portfolio, select investment in large cap pharma, health and wellness, as well as nutraceuticals will continue to add growth while lowering volatility to the overall portfolio. Standouts in the portfolio from last year that we continue to hold include Jameson Wellness, Merck, Planet Fitness, and United Health Group. The 9-Point Alternative Health Fund was launched in March of 2017 and is Canada's first actively managed mutual fund with a primary focus in the cannabis sector. We're proud of our performance in a very challenging market, and it's important to remember the fund remains open to new investors, available for purchase on a daily basis. On behalf of Doug Watterson, my partner in managing the fund, and the entire portfolio management team, I thank you for your support and thank you for listening.